Very warm welcome to all of you in the live discussion on amendment proposed by Union Budget 2021 in capital gain chapter. So they have brought in two new subsections which we're going to discuss today. Section 45.4, actually 45.4 was earlier also there, now it is replaced with the new section, and also section 45.4a. So these two sections are primarily impacting partnership firms. So my today's video is on uh, section 45.4 and 45.4a. I am hopeful that this video will going to add value to you, and it would be I would be able to explain the amendments brought in by the Finance Act by the Union Budget 2021. So if before we move on to the amendments, it would be important to understand the issues that are currently faced by the tax department and taxpayer. So let me open my presentation. And in the meantime, I would request you to kindly do like the video and also subscribe to my channel, so that if in future I'm sharing something, you get the relevant notification. So let's understand the issues, first, and then we'll move on to the amendments. So the current section says the profits or gains arising from the transfer of capital asset by way of distribution. Let me put it on a mute mode. So the profit or gains arising from the transfer of capital asset by way of distribution of capital assets on the dissolution of firm or other association of persons or body of individuals, not being a company or a cooperative society, or otherwise shall be chargeable to tax as the income of firm, association or body of the previous year in which the said transfer takes place, and for the purposes of section 48, the fair market value of the asset on the date of such transfer shall be deemed to be the value of the consideration received or accruing as a result of transfer. This is the current provision which is there. And what are the issues arising from this? The first, a very important issue is whether the term dissolution of firm or otherwise, which is there in the section, includes retirement of a partner or not. It has been widely debated. There are courts which says that dissolution includes retirement, and there are judgment which says dissolution does not include retirement. The next question is, when retiring partner takes only money towards the value of his interest or share in the partnership firm, whether the firm should be made liable to pay capital gain tax. So when there is no transfer of asset, but there is a retirement of a partner, if we assume, let's say, dissolution includes retirement and the partner is retiring, and we have not transferred any asset to the partner, and there is only transfer of money to the partner, so whether there would be any capital gain on the firm. Third question, whether goodwill arising on revaluation of asset at time of retirement is taxable or not. So let's say we reevaluated the goodwill of a firm. We said, I want to take exit from the firm, but there is a goodwill of the firm. The goodwill of the firm is, let's say, 2 crore rupee. So we credited the capital account by the amount of goodwill, and on asset side, we created the goodwill. Now, in addition to assets that got transferred to me, plus goodwill also got transferred to me. So how to tax that? Whether it should be taxable at all or not. And another issue, the fourth one, whether actually is it a relinquishment of rights at the time of retirement? And if it is relinquishment of rights, is it actually a transfer? Because what is taxable is the transfer and not relinquishment. So there is also a debate somewhere that At the time of retirement, it is only relinquishment of right and not transfer. To end all these issues, and to provide the clear guidance, there have been amendment has been made or proposed by the budget in budget 2021. But yes, there could be certain more new litigations because of those proposals. So let's understand what are those proposals. We'll take few example to see, what could be the possible interpretation of those provisions. I have also added couple of case laws before I move on to the proposals. Why those proposals are important and the issues that we have highlighted, how they have been seen in the recent cases by the court. So it is a matter of electroplast engineers, recently pronounced by Bombay High Court. Brief facts of the case are the SSC was running the tube light fittings business for over 13 years. During the current assessment year, a deed of retirement cum reconstitution of the partnership was executed, whereby the original two partners retired from the firm and three new partners were admitted. While doing so, the firm evaluated its goodwill and the retiring partners were paid their share in the goodwill. So they evaluated the goodwill and the whatever the amount was coming, that was paid to the partners, to the retiring partner. The question comes whether it is taxable, the amount which is paid to the partners, to the retiring partners. What was the observation of the court? Court observed that the central question was, would section 45(4) apply even if there was no dissolution of the firm? Issue of transfer of capital asset was not the focal point. In the present case, admittedly, there was no transfer of capital asset upon reconstitution of the firm. All that happened was the firm's assets were evaluated and retiring partner were paid their shares of the partnership asset. There was clearly no transfer of capital asset and hence section 45(4) is not applicable. In another case of dynamic enterprise by Karnataka High Court, Karnataka High Court observed certain things. It was a kind of a, they were having a partnership firm wherein they used to take land, and if some partner is exiting, then they used to evaluate the value of land and then the gain was given to the partner without transfer of any asset. So in order to attract section 45(4), the condition precedent are there should be distribution of capital asset of a firm. Such distribution should result in transfer of capital asset by firm in favor of the partner. On account of the transfer, there should be profit or gains derived by the firm, and such distribution should be on dissolution of the firm. If my presentation is not visible, let me share my screen. Sorry. So, in order to attract section 45(4), the condition precedent are there should be distribution of capital asset of a firm. Such distribution should result in transfer of capital asset by a firm in favor of the partners. On account of the transfer, there should be profit or gains derived by the firm, and such distribution should be on dissolution of the firm or otherwise. In other words, the capital asset of the firm should be transferred in favor of partner. So there should be transfer. In absence of transfer, 45(4) does not apply. So it was giving a planning opportunity to the taxpayers that you may transfer the gain, but there is no need to transfer the asset, resulting in firm ceasing to have any interest in the capital asset transferred, and the partner should acquire exclusive interest in the capital asset. Wherein the partnership firm purchased the property and it was not in the name of any partner. No partner brought that capital asset as capital contribution into the firm. Also, there was no dissolution of the firm because the firm continued to exist even after the retirement of some partner. What was given to the retiring partner is cash representing the value of their shares in the partnership. No capital asset was transferred on the date of retirement. In the absence of distribution of capital asset and in the absence of transfer of capital asset in favor of retiring partner, no profit or gains arose in the hands of partnership firm, and so the question of the firm being assessed under section 45(4) would not arise. So, point to take home that till now, the issues that we highlighted earlier, whether dissolution of a firm or otherwise includes retirement of a partner, whether when the partner is retiring, the money which he is taking should be taxed or not, and if there is any goodwill which is arising because of the revaluation asset at the time of retirement is taxable or not, and whether relinquishment of right falls within the bracket of transfer or not. So there were these issues and the number of judgments coming up, some in the favor of SSC, some in the favor of tax authorities. We have seen couple of judgments, recent judgments on section 45(4) electroplast engineers and dynamic enterprises, which were in favor of the taxpayers. So I think to end the dispute, the government, the CBDT, or we can say the finance ministry has come up with the proposal to introduce two new sections. Section 45(4). It is not 45(4). Hang on. It is 45(4) and section 45(4)(a). So what section 45(4) and 45(4)(a) reads? Let me read for you. Notwithstanding anything contained in subsection 1, where a specified person receives during the previous year any capital asset at the time of dissolution or reconstitution of the specified entity. So now they have specifically included reconstitution in the very section 4. And similarly under section 4(a), notwithstanding anything contained in subsection 1, where a specified person receives during the previous year money or other asset at the time of dissolution or reconstitution of the specified entity, dissolution or reconstitution. So whether it is 45(4) or 45(4)(a), now the law is clear that it includes both dissolution or reconstitution. So even if someone is retiring, without any doubt, now it will fall within the bracket of section 45(4) and 4(a). So what is the difference between 45(4) and 4(a)? So 45(4) is applicable where a specified person receives during the previous year any capital asset. And here, where a specified person receives during the previous year any money or other asset. So first condition, that you are receiving capital asset. Here you are receiving money or other asset. So if you are receiving money, you will not come under 45(4), you will come under 45(4)(a). If you are receiving capital asset, you will come under 45(4), but if you are receiving money and capital asset, you will come under 45(4). It seems other assets do include capital assets. And the more important condition, which we need to read along with the condition mentioned in subsection 4, the line 1 else, which represents the balance in his capital account in the books of accounts. So we are giving the capital asset at the time of retirement or dissolution to a partner, and this capital asset represents the balance in his capital account. And where it is in excess, which is in excess of the balance in capital account, it will go to 45(4)(a). So let's take an example that there is a firm of 3 partners and one partner wants to retire, and the balance of his capital account is 1 crore rupee. Now the partners decided, okay, let's give a particular asset to that partner. Let's say there is a shop which is available. So they are giving the shop to a partner against his capital account, against his balance standing. So now it will come under 45(4). Okay. But now let's say we are giving the money and shop to the partner. As we said, the capital account, the balance in the capital account is, let's say, 1 crore rupee. The fair market value of shop is, let's say, 90 lakhs. And the cash that we are giving is 30 lakh. So in all, what we are giving? 90 lakh plus 30 lakh, 1 crore 20 lakh we are giving to the retiring partner. And the balance in his capital account is 1 crore. So now it is in the amount that we are giving to the retiring partner is in excess of his capital account, because his capital account is of 1 crore and what we are giving 1 crore 20 lakh. So it will come under section 45(4)(a). Whereas in the first case, the value of shop was 90 lakh or 80 lakh, which was less than the 1 crore. So it was coming under 45(4). So wherein you are transferring only the capital asset and the value of capital asset is either less or equal to the capital account, it will come under 45(4). Wherein we are transferring any capital asset or anything else, money or any other asset, and the value is more than the capital account, then we'll go to 45(4)(a). Another important point to watch. Instead of word transfer, the word receives is used. What they are using? Receives. See, notwithstanding anything contained in subsection 1 where a specified person receives. Notwithstanding anything contained in subsection 1 where a specified person receives. So instead of transfer, the word used is receives. Someone may argue that what I am claiming is my right in the partnership firm. There is no transfer. So again, they are trying to end the dispute by using the word receives. So the taxability, the incidence of tax is not attached with transfer. Now it is attached with receive. So let's read 45(4) once again. Notwithstanding anything contained in subsection 1 where a specified person receives during the previous year any capital asset at the time of dissolution or reconstitution of the specified entity, which represents the balance in his capital account in books of accounts of such specified entity at the time of its dissolution or reconstitution. I think we are clear with this. Specified entity would mean a partnership firm. Specified person would mean a partner. Similarly, 45(4)(a), notwithstanding anything contained in subsection 1 where a specified person, that is, let's say a partner, receives during the previous year any money or other asset at the time of dissolution or reconstitution of the specified entity, which is in excess of the balance in his capital account in the books of account of the specified entity at the time of dissolution or reconstitution. So I think we are clear with this. If you have any question, you can put it on the live chat box. Now reading it further, then any such profit or gain arising from receipt of such capital asset by the specified person, that is partner, shall be chargeable to income tax as income of such specified entity under the capital gain. So what they are saying, if there is a transfer and if any gain is arising, then it should be considered as the gain of specified entity, that is partnership firm. In this case, they are saying, if there is any profit or gains arising from receipt of such money or other asset by the specified person shall be chargeable to income tax as income of such specified entity under the head capital gains. So what they are saying, if under 45(4) you are transferring capital asset and there is any gain, that gain would be considered as the capital gain of the entity. Similarly, under 45(4)(a), if you are transferring money and any other asset, then it would be considered again as a capital gain of the specified entity, that is partnership firm. So there is no taxability in the hands of the partner who is retiring. If at all taxability is arising, it is arising in the hands of partnership firm. And shall be deemed to be, I am reading 45.4, and shall be deemed to be the income of the specified entity of the previous year in which such capital asset was received by the specified person, and not extending anything contained to the contrary contained in this act for the purpose of section 45. We will go to the same provisions are there in 45.4a. Fair market value of the capital asset or any other asset on the date of such receipt shall be deemed to be the full value of consideration received or being as a result of the transfer of such capital asset. So now what should be the fair market? What should be the transfer value? It should be fair market. Now, taking an example, let's say I bought a property in a partnership firm for 20 lakh in June 21. Now, one of my partner wants to retire. Let's say we have a firm of 3 partners and one of my partner wants to retire in April 22. Then what will happen? Will certainly the plot or the property that we bought for 20 lakh, assuming now it cost 60 lakh, he would going to ask for his gain. You have the value has increased, and let's say the capital balance of that partner in capital account is 60 lakh. So we said, okay, you can take this plot and there would be full and final settlement. So we transferred that property to the retiring partner. So we will take the law here, we will take the fair market value of the capital asset on the date of such receipt shall be deemed to be the full value of consideration. So on the date of receipt, it would be seen what is the value of that asset in this transfer, and it is 60 lakhs. So what would become the transfer value? 60 lakh. So the gain would be 60 minus 20. 40 lakh would be the gain in the hands of the partnership firm. And the cost of acquisition of the capital asset shall be determined according to the provision of this chapter. While determining the cost of acquisition, we will follow the normal provision. It seems indexation benefit would be allowed, depending upon whether it is long-term, short-term, or whatever the nature of the asset is. Provided that balance in the capital account of the specified person in the books of account of the specified entity is to be calculated without taking into account increase in the capital account of the specified person due to evaluation of any asset or due to self-generated goodwill or any other self-generated asset. So when you are applying this provision, that whether the amount that you are giving to the partner is in excess or not in this capital account, within this capital account, what we will consider? We will consider the balance without taking into account the revaluation due to self-generated goodwill or any other asset. So no revaluation is allowed. So without taking revaluation into focus or without taking revaluation into account, we will find out what is the capital account balance of the retiring partner, and based on the same we will decide whether we need to go to section 45 subsection 4 or we need to go to section 45 4a. For the purpose of this subsection, specified entity means a firm or association person or body of individual, not being a company or a cooperative society. Self-generated goodwill and self-generated asset means goodwill or asset as the case may be, which has been acquired without acquiring any cost for purchase or which has been generated during the course of business. Specified person means a partner of a firm or member of the other association of person or body of individuals in any previous year. Now let me take few examples, and through examples, let me try to explain what 45.4 and 45.4a are saying. So let's take case number 1, a very simple case. Let's say in the capital account of a partner, the balance outstanding is 1 crore, and they are transferring capital asset is 1 crore is without any revaluation. We are transferring a capital asset to the partner towards the full and final settlement. Now, in this case, the amount that we are transferring to the partner, we are not transferring any amount. What we are transferring? We are transferring asset. Now, this capital asset represents the balance in this capital account because we are giving this only. So, what we will do? We will see the fair market value of the capital asset. Let's say the fair market value of the capital asset comes 80 lakh. We will find out cost of acquisition as per normal provision and we compute the gain. This is example number 1, very simple. Now case 2. Let's say the balance is 1 crore. Fair market value of the asset is 1 crore 20 lakh. Now the question comes, should I go to 45.4 or should I go to 45.4? In my view, we should go to section 45.4a because we have transferred the capital asset. And even if I go to 45.4a as far as computation is concerned, answer would going to remain the same. How it will going to remain the same? Because in both the cases, if the fair market value of the capital asset on the date of such receipt shall be due to the full value of consideration. Whether it is 45.4a or whether it is 45.4, in both the cases the same wordings are used. So I am reading 45.4a for the purpose of section 48. It is not there in this line, it is there in my book. It says, for the purpose of section 48, value of any money or the fair market value of other asset on the date of such receipt shall be deemed to be the full value of consideration received or accrued as a result of transfer of such capital asset. So, in both the cases, when I am computing the gain, capital gain, I need to consider fair market value. So, when I am only transferring the capital asset, even if you go to section 45.4 or you go to section 45.4a, the result is going to remain the same. But I personally feel we should go to section 45.4. There is a reason to it. When I will be discussing the amendment in section 48, which has been made, I will highlight why I am saying we should go to section 45.4. Now let's take the case 3. Case 3 is, let's say the balance in the capital account is 1 crore. In order to settle this 1 crore, I am giving him cash of 40 lakhs and also land of 80 lakhs and also, okay, let's keep it simple. I'm paying cash and land. I'm giving cash and land for 40 lakhs and 80 lakhs. Now, am I paying in excess? The answer is yes, I'm paying in excess. So if I'm paying excess, then excess is 1 plus 40 plus 80. Instead of 1, we are giving 1.2, and now it will fall under 45.4. Now, what 45.4 is saying is the fair market value. The fair market value is 80 plus 40. So, what I have transferred, when you are transferring the money, correct? And you are transferring the capital asset. So, total amount that we have transferred is 1.2. And the asset that we have transferred is of, let's say, the land value, assuming it to be, let's say, 60 lakh. So there is a gain which is coming up of 60 lakh. 1.2 minus cost of 60. So the 60 would be taxable in the hands of partnership under section 45.4a. But you will appreciate that out of the 60 lakh, 80 lakh or 20 lakh is towards the increase in the land price, and 40 lakh is towards the cash. So when his capital account is 1 crore, and if I am giving him 1.2 crores, it certainly means 20 lakh I am giving him the excess, and that 20 lakh, out of the 20 lakh, some amount pertains to the land, remaining land, and some amount pertains to business, goodwill of the business. So under 45(4)(a), they are transferring, they are taxing both goodwill of the business and also the gain which is arising on transfer of land. There could be fourth scenario, and fourth scenario is, let's say in a partnership firm there are Mr. A, B, C, they started a partnership firm. They pooled up a money of 40 lakh each. Out of 1.2 crore, they bought a property worth rupees 1.2 crore. Now after 3 years, the value of property goes from 1.2 crore to, let's say, 3 crores. Now each partner will have his own share, each partner is equal partner. So ABC, both A will have 1 crore, B will have 1 crore, and C will have 1 crore. And what capital accounts are representing? Capital accounts are representing 40 lakh, 40 lakh, 40 lakh. Assuming everything other is to be constant. So instead of transferring land, the firm decided to transfer only cash. So the firm paid 1 crore cash to the partners. Now both ask from where this cash has come. It is in the bank account, maybe through rent. But just for the sake of simplicity, we are trying to understand. Now this 1 crore, they have paid it to the bank, no capital asset has been transferred. Now you will see that after 45(4)(a), if 40 lakh is something which is representing in the capital account of the partner, and how much we have paid? We have paid 1 crore, which is in excess of the capital account. So it will fall under 45(4)(a) certainly, and the excess amount 60 lakh will be taxable in the hands of partnership firm. This is what the new proposal is saying. So I think we are clear on the new proposal. But what will happen when the firm will transfer the asset finally? Like after 4 years, the partner decided to sell the building. What will happen? There will be a gain, and on that gain, they again need to pay tax. So they have brought in a provision in the section 48. Case of specified entity referred to in subsection 4A of section 4 of 45. The amount included in the total income of the specified entity under subsection 4A of section 45, which is attributable to the capital asset being transferred, calculated in the prescribed. See why we are referring to 45(4) and not 4(4). Let's understand this. Because in 45(4) you are already transferring the capital asset. So again the transfer will not happen of the same asset. Now if it is 45(4)(a), because you will see that we have transferred the money to the partner, and that increase in the capital of the partner is because of the increase in the land value, which already got taxed because of the 45(4). And because 45(4) is saying the amount which you have transferred to the partner in excess of the balance should be taxed. So I am already taxing 60 lakh. So 60 lakh increase is towards what? Towards the land value. Now when I will transfer, I am finally saying, I am finally, after 3-4 years when I will be finally selling the land, again there will be a capital gain. So there will be a double taxation. Earlier also you tax 60 lakh. Now you want to again tax the capital gain. So now in order to avoid that hassle, we have brought in subclause 3 in 48, which reads, in case of specified entity referred to in subsection 4A of section 45, the amount included in the total income of such specified entity under subsection 4A of section 45, which is attributable to the capital asset being transferred in the prescribed manner. So they are saying they will going to come up with the regulation that how the value should be computed, but this is the just which I am telling you. We need to wait for the final regulation. With this, I'm done with my presentation. I hope you liked it. Whether the issues are finally settled or not is, we can only time can tell. But if you ask me, then we're going to have new issues, and the valuation is going to become more important. Uh, there could be issues for few issues which I can feel would come up. One is section 45(4) whether it's 4A. Second could be transfer whatsoever you receive. So what will if I'm transferred the asset in 1 year and the receipt of the asset in the another year? Third, what qualifies a receipt? What do you mean by receipt? There could be legal litigation around this. Then you could also see, the issue regarding the fair market value, which was also there earlier. But now for each asset, if you are computing the fair market value, it is going to create a trouble. So there could be more issues. I think we need to wait for the computation mechanism that is going to come. My suggestion to the CBDT would be to come up with some examples to clarify what exactly they want to say in section 45(4) or 4A, for the benefit of everyone. Uh, Now, guys, I will come up with my next video on a very interesting topic, liable to tax. Maybe Monday, the coming Monday. Not sure I will be traveling, but I will try either to put that video on Sunday or Monday. I will text you on the WhatsApp or on the Facebook or on the LinkedIn. You will find. I would request you before I finally say goodbye to you. I would request you to kindly like my video and share your feedback. Thank you.